Okay, let's unpack this. You hear U.S. Central Bank or Federal Reserve, and maybe, your eyes glaze over a bit, thinking it's just for economists.
Right, super technical stuff, far removed.
Exactly. But lately, the whole idea of the Fed's independence, it's exploded into the headlines. It's suddenly very real.
Yeah, definitely not just an academic debate anymore.
We're seeing things like former President Trump's very public comments about Fed Governor Lisa Cook, his criticisms of Chair Jerome Powell. It's really bringing the Fed's role, its autonomy, right into the spotlight for everyone.
And that's really what we want to get into today. Our mission is to go, beyond those sound bites, to really take a deep dive into what the Fed actually does, why its independence is seen as so foundational, so critical for our economy.
And what could happen if that independence gets shipped away or, well, even dismantled?
Exactly. The goal is for you, the listener, to get the so what behind all this. Why these complex economic and political arguments actually matter to your wallet, your savings, your loans.
Absolutely. So we hear the Fed all the time. News, finance shows everywhere. But what is it, really? What's its job in the economy? It feels kind of mysterious sometimes, powerful, but behind the curtain.
That's a really good way to put it. And yeah, let's demystify it. The Federal Reserve System, basically, it is the central bank of the United States.
Okay.
Congress set it up way back in 1913. And that was after a whole series of financial panics. Think the Panic of 1907, the system almost totally collapsed.
Right.
No central authority, you see.
Yeah. Okay. So it was born out of crisis.
Precisely.
Yeah.
To prevent that kind of chaos. And it has 5 main jobs, 5 key functions, all aimed at keeping the U.S. economy healthy and the financial system stable.
5. Wow, that sounds like a lot for one organization. What are they? And maybe more importantly, how do they actually touch our lives?
Yeah, it does sound like a lot, doesn't it? But they're all interconnected, working towards, hopefully, a stable environment for you. So first, the big one, monetary policy.
Right. Interest rates and all that.
Exactly. Managing the country's money supply, credit, aiming for maximum employment, stable prices, and moderate long-term interest rates. That's often called the dual mandate.
Dual mandate. Okay.
Think about how hard that is fighting inflation without tanking the job market, or vice versa. It's a constant tightrope walk. And that directly impacts your job security, how far your paycheck goes.
That makes sense. A balancing act. What are the others?
Okay, second, promoting financial system stability, trying to minimize big systemic risks, prevent another 2008-style crisis or those earlier panics.
So stopping the dominoes from falling.
Pretty much. They act as a lender of last resort for banks. Keep money flowing in a crisis. That protects your deposits, keeps the system from freezing up.
Important.
Third, they supervise and regulate banks. Make sure they're sound, not taking crazy risks that could blow things up. Fourth, they work on the plumbing, the payment systems. Yeah, making sure when you swipe your card or transfer money or get your direct deposit, it all happens smoothly, safely, efficiently. They provide services to banks, the government.
Ah, okay. The behind-the-scenes stuff we take for granted.
Totally. And fifth, consumer protection and community development, using supervision, research, making sure consumer laws are followed. And what's really interesting is its structure.
How so?
It's not just a single government agency. It's decentralized. There's a board of governors in D.C., but also 12 regional reserve banks across the country, plus the FOMC, the Policy Setting Committee.
FOMC, I hear that acronym a lot.
Yeah, the Federal Open Market Committee. They're the ones who actually meet 8 times a year, usually, to set those key interest rates you hear about, the target federal funds rate.
Got it. So they're the ones pulling the levers on rates.
That's the main group, yes. It's this blend of public oversight and regional, sort of private sector input through the reserve banks. Pretty unique setup, designed that way.
Okay, so it's this powerful, complex body with huge influence. Which brings us back to independence. Why set it up to be so separate from politics? Couldn't the president just, tell them what interest rate to set, especially if an election's coming up?
That independence is absolutely fundamental, and it was deliberate. Congress wanted to insulate the Fed from short-term political pressures, avoid, as one analyst put it, political decision-making on so important an economic force.
Right, like boosting the economy right before a vote, even if it causes problems later?
Exactly that kind of thing. Short-term gain for long-term pain, potentially massive inflation down the road. Independence is crucial for credibility. And that's not just domestically. The U.S. dollar is the world's reserve currency.
The global aspect.
Yeah, global markets, other countries, They need to trust that the dollar's value isn't being manipulated for political reasons. That trust lets the U.S. government borrow money much more cheaply than countries seen as less stable.
And cheaper government borrowing affects us all, eventually. Lower taxes, maybe, or just lower rates generally.
It ripples through the whole system, absolutely affects the rates you pay on mortgages, car loans, everything.
Okay, that global trust angle is huge. How is that independence actually protected, like, legally?
It's pretty strong, legally speaking. Fed governors, including the chair, serve long, staggered terms. And crucially, they can only be fired for cause.
For cause, what does that mean, practically?
It means serious misconduct, malfeasance, gross negligence, something demonstrable. It's not at will, like many cabinet secretaries or political appointees who serve at the pleasure of the president.
So the president can't just fire the Fed chair because they disagree on interest rates?
Nope. That's the whole point. It requires due process. Innocent until proven guilty. There has to be a real, substantial reason related to misconduct, not just politics. It's a shield.
That's a really important distinction. So let's play this out. Imagine a president says, Governor X, you're fired. But the governor says, no, I'm not. You don't have cause. What happens then? Sounds like chaos.
It would be chaotic and incredibly damaging. That kind of standoff creates massive uncertainty. It would make the U.S. financial system look unstable, maybe like something you'd see in less stable economies.
And the markets would react badly.
Immediately. The expert analysis we looked at said this kind of instability would be incredibly costly for all of us, not just Wall Street types. It hits everyone. It could shake that global trust in the dollar we talked about.
So higher borrowing costs for the government, higher rates for us. A mess.
A potential mess, yes. That's why the legal framework is there, to prevent that exact scenario.
And we don't really have to imagine too hard, do we? This August, former President Trump publicly tried to fire Fed Governor Lisa Cook, said there were unproven allegations of mortgage fraud. What was that about?
Yeah, that really brought these issues to a head. Trump posted on social media making these claims about an old mortgage of Cook's without, showing any public evidence, called for a DOJ investigation. And then the very next day, another official, not the Justice Department, announced they'd found her guilty, which clearly suggests no real investigation happened, no due process.
Right.
Governor Cook, meanwhile, stated the president doesn't have the authority to fire her without cause, and she plans to stay. It's a textbook example of that tension. Political pressure versus the Fed's legal insulation.
So these public attacks are one thing, but are there other ways, maybe less obvious ways, that a president can try to influence the Fed?
Oh, absolutely. This isn't new either. During his first term, former President Trump constantly pressured Chair Powell, publicly and probably privately, to lower interest rates.
I remember that. Lots of tweets.
Lots of tweets. Calling Powell names, demanding rate cuts, now WO, even suggesting the Fed board should take over if Powell didn't comply. Very direct pressure.
But you're saying there are other ways too, quieter ways.
Yes. Appointments are a key one. A president appoints the Fed governors, including the chair, subject to Senate confirmation, of course.
Ah, so they can shape the board over time.
Exactly. Look at the recent sudden resignation of committee member Adriana Kugler. That creates an opening the White House can fill. There are concerns sometimes about a brain drain, experts leaving if the political heat gets too intense.
Making way for people more aligned with the administration's short-term goals, perhaps?
That's the concern. You might shift the balance subtly over time, influencing policy without a direct confrontation over firing someone.
Okay, that makes sense. But does this pressure actually work? Has it historically changed Fed policy and affected the economy? Or is it just noise?
That's the million-dollar question, right? And history gives us a pretty clear answer. There's research by Thomas Drexel, who looked at interactions between presidents and Fed officials from the 1930s to 2016.
And what did he find?
He found compelling evidence, particularly with the Nixon administration. Nixon heavily pressured Fed Chair Arthur Burns back in '71 to ease up on monetary policy before the '72 election.
How do we know this?
We actually have the Nixon takes and Burns' own diary entries. Nixon is heard urging Burns to start expanding the money supply. Pretty direct.
Wow. And what was the result? Did the economy boom?
Well, not exactly, and definitely not in a good way long term. Drexel's finding was stark. That kind of political pressure strongly and persistently raises inflation and inflation expectations.
Raises inflation.
Yeah.
But what about the economy? Jobs?
It had little impact on economic activity, so Nixon's pressure. It led to interest rates being about 1% lower than they probably should have been.
Okay.
But the price level was 5% higher after 4 years. It basically bought a tiny bit of short-term easing at the cost of fueling the major inflation problems of the 1970s.
So it backfired. More inflation, not much real growth.
Precisely. A clear historical lesson.
Yeah.
Messing with Fed independence for political reasons tends to lead to higher prices for everyone without really helping the underlying economy.
That's a sobering example. Okay, so beyond these kinds of pressures and historical examples, there are even bigger ideas being floated now. Project 2025, that conservative plan for a potential second Trump term. What does it propose for the Fed? Sounds like major changes.
Oh, it's proposing truly radical shifts, really rewriting the rule book. First, they want to scrap the dual mandate.
Get rid of the focus on employment.
Yeah, just focus on price stability, monetary stability. That's it. Second, limit the Fed's power to lend in emergencies, get rid of some key policy tools it uses.
Okay.
Third, they actually question whether the nation needs a central bank at all.
Whoa! Abolish the Fed!
It's on the table in their discussions. And fourth, they talk about bringing back things like free banking and maybe even returning to the gold standard.
Free banking, gold standard. That sounds like going back a century or more. How do those ideas hold up when you look at history?
Not well. Not well at all. They really are from a different era, and we left them behind for very good reasons, mainly instability.
Okay, tell me about free banking.
So before the Fed, in the 19th and early 20th centuries, you had periods of free banking. Basically, private banks could issue their own currency. No central control over money supply or rates.
Sounds chaotic.
It was. It led to constant financial panics, like 1907, which we mentioned, bank runs, failures all the time. There was no lender of last resort to step in. It was sometimes called wildcat banking, pretty unstable.
Sure.
The Fed was created precisely because free banking failed so badly.
Right. Created to fix a problem they want to bring back. What about the gold standard?
Similar story. The U.S. dropped the gold standard during the Great Depression back in 1933. Why? Because tying the currency to gold severely limited the government's ability to fight the Depression, to manage the money supply effectively.
I don't need things worse.
Many economists argue it absolutely did. It contributed to instability, high unemployment. One analysis calls the gold standard the principal threat to financial stability between the world wars. It caused volatile swings in inflation and growth.
So Project 2025 ideas.
They basically ignore history and 150 years of economic experience. As one commentary put it, it's like peddling economic snake oil.
Strong words. Does Project 2025 propose anything else regarding the Fed? Maybe less radical?
Well, it does have some points about focusing on bank capital, which is more mainstream, but then it kind of goes off the rails again, criticizing the Fed for things like considering ESG factors, environmental, social, governance, and regulation.
ESG, like sustainable investing guidelines.
Yeah, or policies aimed at ethical practices. They see that as political overreach. They also criticize recent quantitative easing, or QE.
Right, QE. Remind us what that is.
Sure. Quantitative easing is when the Fed buys up assets, like government bonds, on a massive scale, usually during a crisis. The goal is to pump money into the system, push down long-term interest rates when cutting the main rate isn't enough.
Okay. Controversial, but used after 2008 and during COVID. Exactly. Project 2025 is critical of that, too. And there's this undercurrent, kind of an anti-intellectualism. You see quotes from advisors basically saying, all these PhDs over there at the Fed, I don't know what they do, dismissing their research.
Okay, so that's a very specific, very different vision for the Fed.
Yeah.
What about the other side? What's the Democratic view, say, from Vice President Harris?
That's a pretty sharp contrast. Generally, the Democratic platform doesn't get deep into monetary policy specifics. It's pretty standard. Parties tend to keep central banking at arm's length.
Right.
But Vice President Harris has explicitly endorsed, the more traditional respect for Fed autonomy. She stated publicly that as president, she would never interfere in the decisions that the Fed makes.
So, hands off.
That's the message. And it mirrors President Biden's approach. He very rarely commented on Fed decisions, even when they were raising rates pretty aggressively to fight inflation, which wasn't necessarily popular politically. He publicly backed their independence.
So a continuation of the status quo versus potentially radical change. That seems to be the core difference in an approach being presented. Respect for the existing independence versus fundamental restructuring or even questioning the Fed's existence.
We've covered a lot of ground here. The Fed's key jobs, why its independence matters, the recent political clashes, the Nixon history, and these really different visions for its future Project 2025 versus a more traditional view. It's clear these aren't just abstract economic debates anymore.
Not at all.
They have real, tangible consequences for our economy's stability, the value of the dollar globally, and that impacts everything from how much it costs you to borrow money to the price of groceries.
Absolutely. And maybe that leads to a final thought for you, the listener, to mull over. Given what we know from history that political pressure can fuel inflation, and given these proposals for really radical changes to the Fed,
Yeah.
how might you think about your own financial planning? Your savings, your investments, even just your basic budgeting. What kind of personal safeguards or maybe just increased economic awareness might become even more vital if the institution designed to provide stability is itself facing such fundamental questions about its future and its independence?
Something to definitely think about.